Um, so in Q1 of 2026, the company that literally charges a premium to tell Fortune 500 CEOs how to run their businesses, they actually had almost 40% of their own highly paid consultants just sitting entirely idle.
Yeah, it's a wild statistic.
Right. So today, we are looking at Gartner's financials to figure out what happens when, well, the ultimate corporate navigators hit a localized roadblock.
It's definitely a fascinating situation.
Welcome to your custom-tailored deep dive. We're looking at a stack of sources detailing Gartner's Q1 2026 financial results. But, the goal here isn't just to rattle off accounting figures for you.
No, nobody wants to just listen to us read a spreadsheet.
Exactly. We wanted to decode the underlying business story. Like, what do these numbers actually tell us about corporate spending right now?
And what do they show about the real-world adoption of AI?
Yes, exactly. And how is a business that is built on advising the future managing its own present?
It's a really great look under the hood. Because, Gartner is the ultimate bellwether, right?
Oh, for sure.
If you want to know what the C-suite is genuinely worried about, you don't look at their PR statements. You look at what they're actually paying Gartner to help them understand.
Right. And to understand the financials, we really have to start with the machine that generates them. So Gartner operates on this massive flywheel model.
Yeah, the flywheel.
The presentation notes they have over 2,400 former practitioners acting as experts.
Which is key. These aren't just researchers. These are people who used to be, chief information officers or supply chain directors.
Exactly. And they are fueling this engine with over 510,000 client interactions.
Yeah.
And like 23,000 vendor briefings every single year.
It's a massive amount of data.
Okay, well, let's unpack this, because my read on this is that Gartner isn't just like a static library of PDF reports.
No, not at all.
It functions a lot more like a crowdsourced traffic app, like Waze,
Right.
but built exclusively for the C-suite.
I think the Waze comparison is highly accurate. Because every single time one of those 510,000 clients asks a question, say, about AI governance or talent retention, they are essentially reporting a pothole or a speed trap on the corporate highway.
Right, they're flagging an issue for everyone else.
Exactly. The system ingests that query, analyzes it, and immediately makes the map smarter for the next CEO who logs in.
Which creates a huge network effect.
It really does. The sheer volume of users actively improves the product for everyone. And in a world characterized by just complete information overload, that kind of objective, unbiased, actively updated insight it becomes a highly monetizable commodity.
Yeah, we definitely see that monetization reflected in the top line. They posted $1.51 billion in Q1 revenue.
Yeah, billion with a B.
But, that headline number masks some pretty intense cross-currents.
Yeah.
To really gauge their health, the metric that actually matters is contract value, or CV.
Right. CV is the lifeblood of any recurring subscription model.
Because raw revenue is just looking backwards.
Yeah.
Right?
Yeah. Raw revenue tells you what cash cleared the bank yesterday. But contract value, which is the annualized value of all active subscription contracts, that tells you how much cash is virtually guaranteed to clear the bank tomorrow.
So it's forward-looking.
Exactly. It's the purest indicator of business momentum.
So globally, their contract value is sitting at $5.3 billion.
Huge number.
But if we look at the growth rate on an FX-neutral basis, meaning, we strip out the daily noise of foreign currency exchange rates, that $5.3 billion grew by just 1.0% year over year.
Which, feels incredibly flat for a tech-adjacent company.
Right. But the data actually provides a really crucial caveat here. Because if you carve out the U.S. federal government from those figures, their global contract value growth actually jumps to 3.5%.
That 2.5% delta is significant. It illustrates how massive government entities operate on entirely different gravitational pulls than the private sector.
Yeah, the private sector is chugging along, but the government is stalled out.
Exactly. Because in early 2026, the U.S. federal landscape has been defined by complex budgetary standoffs, right? You have continuing resolutions, freezing agency spending levels, election year paralysis.
So nobody wants to commit to long-term contracts.
Precisely. When an agency like the DoD or Health and Human Services isn't sure what its discretionary budget will be next quarter, the absolute easiest thing to pause is an external advisory contract.
That makes total sense. It acts as a localized anchor on Gartner's otherwise steady corporate growth.
Exact.
But even with the corporate growth at 3.5%, I'm looking at another metric that suggests some underlying friction.
Okay, what's that?
Well, if this service is as essential as a GPS in a storm, like we said, we need to talk about their wallet retention. because it is definitively dropping.
Ah, yeah, the wallet retention numbers.
Right. So for global technology sales, it went from 101.1% in Q1 of 2025 down to 96.5% in Q1 of 2026. And global business sales dropped from 105.2% down to 98.3%. I mean, if they are so essential, why is wallet retention slowly dipping below 100%? Because that means existing clients are actively shrinking their footprint, right?
They are. They're optimizing their spend. Because remember, wallet retention measures how much revenue you're extracting from the exact same cohort of clients compared to a year ago.
Right.
So when it sits above 100%, your clients are expanding. They're buying more seats, maybe adding subsidiary divisions to the contract or upgrading to premium tiers.
But dropping to 96.5%, that indicates a shift in corporate behavior.
Exactly.
It tells me they're going through their software stacks with a fine-tooth comb. Like, a client isn't churning completely, right? The overall enterprise retention rate is still holding strong around 85%.
Yeah, which proves the core service is very sticky.
Right. But a CIO is looking at their department and saying, we definitely still need the Gartner subscription, but do we really need 50 individual licenses for the team? Let's just renew with 40.
The belt tightening is surgical. It's not structural. And that targeted reduction makes total sense when you realize Gartner isn't a monolith.
Right, they have different segments.
Yeah, they have 3 distinct reporting segments. And the drop in enterprise spending isn't just happening across the board. In Q1, those 3 segments performed radically differently.
Okay, let's break down that divide, because we should start with the dominant engine, which is the Insights segment.
Oh yeah, the crown jewel.
This is the subscription-based intelligence. Insights brought in almost $1.3 billion in Q1 revenue, and that's growing at 3.1%.
Right.
But the standout figure here isn't even the revenue, it's the profitability. The contribution margin for Insights is 78.2%.
What's fascinating here is that a nearly 80% margin is basically the holy grail of software as a service economics.
Oh, absolutely.
It means that for every new dollar of subscription revenue that comes in the door, almost 80 cents drops straight down to the bottom line after covering direct costs. Right. Because the fixed costs, like the analysts writing the reports, the server infrastructure, those are already paid for. Adding one more subscriber costs Gartner practically nothing.
And they are supercharging this segment right now with a tool called Ask Gartner.
Yes.
This is their proprietary generative AI interface. So instead of a client having to manually search through a PDF library of like 10,000 reports to find a specific answer about supply chain logistics, they just ask the AI.
It completely changes the user experience. The Gene AI acts as this synthesis engine. It instantly digests those 500,000 annual client interactions we talked about earlier and spits out a cohesive, customized strategy.
It's just instant value.
Exactly. It increases the perceived value of the subscription, which is exactly how you defend an 80% margin against corporate budget cuts. You make the tool too fast and too integrated to turn off.
So while they're leaning heavily into AI for their Insights segment, their second segment actually proves human interaction is still highly valued.
The conferences segment.
Right. Conferences brought in $78 million in Q1. They hosted 10 destination conferences, pulling in over 11,400 attendees.
Yeah.
And the same conference revenue growth is sitting at a very robust 9.0%.
You know, there was a prevailing theory post-2020 that digital transformation would just kill the massive corporate offsite.
Oh yeah, everyone thought physical networking was dead.
But the exact opposite is happening. As AI handles more and more of the raw data analysis and report generation, human trust becomes the premium currency.
That makes a lot of sense.
Executives are still totally willing to pay top dollar to fly to a destination conference, not to read a slide deck they could have downloaded, but to look their peers in the eye.
Have those off-the-record hallway conversations.
Exactly, and validate their strategies in person.
Okay, so the data subscription is growing and the physical networking is booming. But that brings us to the third segment, which is consulting.
Yeah, here's the stumble.
And this is where the floor just fell out. Consulting revenues dropped 14.7% year over year, landing at $119 million.
That is a severe drop.
Within that segment, labor revenues were down 13.4%, and contract optimization revenues plummeted 18.5%. I mean, their billable headcount dropped by nearly 10%, and their backlog of future signed work shrunk down to $201 million.
It is a severe contraction in their most labor-intensive division.
So are clients keeping the gym membership but firing the personal trainer?
Oh, that's a perfect analogy. Yes.
Because it seems like companies are keeping the Insight subscription. They still need access to the equipment. Right, the data.
Right.
But they are firing the personal trainer. They're looking at the macroeconomic climate and deciding that instead of paying Gartner's consultants to implement the strategy, they'll just take the raw data and have their internal teams execute it to save money.
Exactly. And you can see the immediate financial strain that do-it-yourself client mentality puts on Gartner just by looking at their internal utilization rate.
Oh, the utilization rate.
Yeah. In Q1, their consulting utilization fell to 61.4%.
Wait, meaning almost 40% of their highly paid consulting bench is essentially sitting idle on any given day.
Right. And in a human capital business, idle time is toxic to the bottom line.
Because you're still paying them.
Exactly. You're still paying the base salaries and benefits for those former practitioners, but they aren't generating billable hours to offset the cost. This is the direct mechanism that caused the overall contribution margin for the consulting segment to collapse down to 30.9%.
Which is less than half the profitability of the insights segment.
Exactly.
Wow. But you know, when a sophisticated management team sees their high-margin software business humming along, but their labor-intensive consulting business hits a wall of idle capacity, they don't just sit on their hands.
No, they act.
Here's where it gets really interesting. The Q1 results show a massive pivot in capital allocation. They are restructuring the portfolio and aggressively engineering value for their shareholders.
Right. We see the first move of that restructuring on the balance sheet with the divestiture of digital markets.
Yeah.
In February 2026, Gartner sold off this operation, recognizing a $6.1 million gain on the sale in Q1.
But, I mean, a $6 million gain on a massive balance sheet is basically a rounding error, right?
It really is.
The real story here is what happened the year prior. Because in 2025, Gartner took a $150 million goodwill impairment hit directly related to this digital markets division.
Yes, that's the vital backstory hidden in the balance sheets.
Let's unpack the mechanics of that for a second. Because an impairment isn't an actual cash loss in that quarter, it's an accounting reality check.
Exactly. When one company acquires another, they often pay more than the raw physical assets are worth.
Right.
You might buy a company with $50 million in hard assets, but you pay $200 million because you believe in the brand or the customer list or the synergies.
And that $150 million premium is recorded on your balance sheet as an intangible asset called goodwill.
Spot on. But auditors don't let you just keep imaginary value on your books forever. Every year you have to test it.
You have to prove it's still worth what you said it was.
Yes. You have to prove that the asset is still generating the value you projected. So in 2025, Gartner effectively had to admit that digital markets was underperforming its acquisition thesis so severely that they were legally required to erase $150 million of perceived value from their books.
Oh, wow. So shedding it completely in early 2026 isn't a triumphant exit. It's a clinical amputation of a distraction.
It really is. It signals a ruthless focus on their core competencies. They're refusing to throw good money after bad.
Right.
By cutting digital markets loose, management is freeing up operational bandwidth to focus entirely on the massive cash engine that is the insights segment.
And the cash that engine is generating is phenomenal. Just in the first quarter, Gartner generated $371 million in free cash flow.
Right. Free cash flow being the vital metric here. It's the actual physical cash left over after paying all operating expenses, salaries, and capital expenditures required to maintain the business.
So you have $371 million in fresh cash sitting on the table in just one quarter. But the company also has a stated $3.0 billion in total debt. Now, the conventional, conservative wisdom would be to take that cash and pay down the debt. But Gartner isn't doing that.
No, they aren't. And they aren't paying it down because the structure of that debt is a massive strategic advantage.
How so?
100% of that $3 billion is fixed-rate debt.
Oh, wow.
Right. In a macroeconomic environment where interest rates have been unpredictable and inflation remains a factor, having locked-in fixed-rate debt means you are effectively paying back your lenders with tomorrow's devalued dollars.
That's incredibly smart. And their consolidated leverage ratio, which calculates their total debt relative to their earnings, is sitting at a very safe 1.6 times.
Exactly.
I read their banking covenants actually allow them to push that ratio all the way up to 4.0 times. So they have a massive cushion.
They do. There is absolutely zero structural pressure forcing them to pay down those loans right now.
So the management team is faced with a classic capital allocation problem. You have massive free cash flow, you don't need to pay down debt, and you just sold off a peripheral business unit because acquisitions are risky. Where do you put the money to maximize return?
You buy your own stock.
and they're doing it aggressively.
Very aggressively.
The Q1 numbers show they spent $535 million on share repurchases in just 3 months, and they still have another $1.2 billion authorized by the board ready to deploy.
The underlying math driving this decision is a metric called return on invested capital, or ROIC. Gartner's ROIC sits at an incredible 27%.
Which is huge.
It is. This means that historically, for every dollar of capital they inject into their own operations, they generate a 27% return.
Right. So if you're the CFO, you look at the open market. Can you find a startup to acquire that guarantees a 27% return? Unlikely.
Very unlikely.
Can you launch a new product line with zero risk that yields 27%? No. So mathematically, the highest yield, lowest risk place to put $500 million is right back into your own shares.
Exactly. It shrinks the denominator. By taking those shares off the open market and retiring them, the company's overall profit is now divided among a smaller pool of remaining shares.
Down to roughly 69 million shares in their updated guidance, I believe.
Right.
Which creates a fascinating illusion on the income statement. Because even though Gartner's total top-line revenue actually shrank by 1.5% overall in Q1, their adjusted earnings per share, the EPS, jumped 11.4% to $3.32.
It's brilliant.
The pie got slightly smaller, but because they bought out so many people at the table, the remaining slices got significantly larger. It is a masterclass in financial engineering for a mature business.
It really rewards the long-term shareholders who stay the course. You weather the macroeconomic headwinds, fiercely protect your high-margin recurring revenue, and use the excess cash to consolidate ownership.
Bringing this all together for you, the listener, Gartner's Q1 provides a perfect X-ray of the corporate landscape in 2026.
It really does.
On one hand, you have a highly resilient, deeply embedded intelligence service, a $5.3 billion global contract value, operating at near 80% margins, proves that data is the ultimate commodity.
Absolutely.
And they're aggressively trimming underperforming assets and using fixed-rate leverage to orchestrate massive shareholder returns.
But the headwinds are equally instructive here. The undeniable dip in wallet retention, the freeze in government spending, and the severe 14.7% contraction in consulting revenue, they paint a clear picture of an economy that is highly focused on optimization.
Yeah.
Companies want the roadmap, but they are increasingly unwilling to pay a premium for a human to drive the car.
It is a dynamic tension between the value of information and the cost of implementation.
And that tension leads to a really profound question about the future, building directly on the strategy we've analyzed today.
Okay, let's hear it.
Well, we discussed how Gartner is deploying Ask Gartner, right? Their proprietary Gen AI tool to instantly synthesize answers for their clients.
Right. It makes the insights segment infinitely more valuable.
It turns a passive library into an active advisor.
Exactly.
But consider the trajectory of that technology. As generative AI evolves past simply retrieving data and becomes capable of formulating complex, multi-step business strategies, could the very technology Gartner is using to defend its subscription revenue eventually completely cannibalize its own consulting segment?
Oh, wow.
Right. If an AI interface can instantly draft an enterprise-grade AI governance framework or build a robust supply chain risk model based on 510,000 real-world interactions, why would a CEO pay a team of human consultants hundreds of billable hours to do the exact same thing?
That is the existential question.
Yeah. Is the 14.7% drop in consulting revenue just a temporary result of macroeconomic belt-tightening? Or, by building the AI that automates the synthesis of corporate strategy, has Gartner introduced the canary in the coal mine for the permanent decline of human advisory services?
That's a fascinating point. If the ultimate corporate navigators are building the engine that automates navigation, that utilization rate of 61.4% might not be a valley.
No, it might be the new ceiling.
That is definitely something for you to ponder, long after this deep dive ends. The flow of capital isn't just showing us where corporate budgets are being trimmed today. It might be showing us exactly what the future of knowledge work looks like tomorrow.